You can start now.
Okay. Good day to one and all. This is Dr. Sivaraman of iknowindices.com. So after the British exit scenario, you come across terrific expectations in the market. People are giving different interpretations, different derivations, and you find the extreme thinkings are happening in the market. I was giving the Asian session live market analysis webinar during that of the Japanese session by 5 GMT and noted down the initial lows and the highs, and I was telling that they had just done the extended downward move for 2 hours below that of the initial low, and afterwards they are expected to gain. Australian dollar was gaining already, and that was a sign that they wanted to recover the market all along. From that of the low, they started recovering Euro, GBP as well as USD and also Australian dollar. So this is the way the players make the moves in the market. And so we need to understand during such spike times on the upside or on the downside, how do we handle position? That is vital. So whether our forecast is coming true or not is important. But the most important thing is how exactly we handle the trade so that we are in a position to earn money in uncertain market, because the market is bound to be uncertain most of the time. So yesterday I gave by 8 to 8 GMT, before that of the UK EU referendum, the trade call. Then subsequently, I said that I will come back today and discuss the post-event. Now, as per my algorithm, Euro and GBP are expected to make the slide during that of the US session yesterday. European session, I gave the webinar and it was expected to rise. It was expected to rise during that of the European session and then slide during that of the US session yesterday. That is today's forecast. I have given it now. So when they made the slide yesterday, then also the rise during that of the European session. And when the market was moving in line with that of the expectations, so I assumed that there could be unchanged condition. So as a result, today they are expected to gain the levels. But the outcome has turned out to be opposite. That is, British exit has become the reality after the voting. But still, we need to find out how politically they are going to present it. We have to wait and see. So here today, during that of the Japanese session, they are expected to make the swing and rise, and they made the extended downward move and recover from there. And this is what happened. Then subsequently, swing and rise is expected during that of the European session, and slowly they are gaining the levels. We need to see how far they are handling during that of the US session for the weekend, because obviously after that of the drop, when people find that technically there is no point in holding buy position, anybody can sell, and when we try to sell, we don't question who is buying. When I am selling in a desperate condition at different levels, who is buying, and is he a fool buying at the lowest level? And that is what at these levels, and probably after that the market has fallen further down. So I am in the money, so let me be happy about it. And probably GBP could go to parity and then I'll book profit. That sort of imagination is immediately creeping. And then what happens? The players started gaining the levels in order to induce such short sellers to do the short covering. So the players initially dropped so that those who had taken the buy position of holding and expecting the rise in the market suddenly find that the market has collapsed and fundamentally it has to drop. So they liquidate the long and turn short. And then later on, they realize that short is not making money and they wait anyhow. Fundamentally, it is going to be weak. So let us add more sell positions when they gain. That is what they think. then subsequently the players gain all along and say that the market has to recover with a different story, because it is not going to be the immediate exit. It might be after a few years. So before that, one can make different type of moves in the market. And I was explaining during the Asian Session Live Market Analysis webinar, already because of the combinations of currencies in the European area, you come across only euro as a single currency. And earlier you come across the Deutsche Bank, Italian lira, French francs, etc. And subsequently you find everything has become single currency. So the number of currencies now as majors are only 4 to trade with. And in that scenario, Switzerland was not joining with the euro, even though it has joined in connection with the visa issuance. So you find that there are only 4 majors. And even if GBP is considered as a regional currency, then there will be only 3. But this is one of the oldest currency in the world, and which has got the numerator status. And you know that Britain was ruling most of the part of the world in about a few hundred years back. So that is why it has got so much of importance, even though it is such a small place when compared to that of Europe or USA. But still, you find the status they may not be willing to lose, even though the referendum has come out differently to isolate. Probably they can give a different type of political interpretation for that, and then satisfy those who want to exit. At the same time, they will continue that relationship. So that is what they could do, and that could give the trigger for the market and the GBP to gain all the way the levels. So keep in mind that the players are here to make the whipsaw moves during the event time, and they have to buy instruments in the market. They don't have any other option for their money to work and earn. So they have to invest in all markets. You come across all over the world, the stock markets and the currency markets have dropped. Okay, all have dropped. Everybody thought that US dollar is a safe haven, and Japanese yen is a safe haven, gold is a safe haven. Okay, after going there, what they can do? They have to exit with their positions. So they have to book profit everywhere, and only then the realized profit can be used. So whatever the euphoric condition they create, don't be moved with that. The market is known to create the sentiments, and the players are expected to act against the traders spending positions. This is what happening in the market all along. And many of the people asked me that such a huge drop of 1,600 pips in the case of GBP and about 450 pips drop in the case of euro, these things happen. Have you ever seen it? But actually that was the normal type of trading happening in 1998, 99 up to 2003. And invariably we have seen currencies making about between the high and the low about 1,000 spread in a day, 24-hour cycle, and sometimes about 1,600 pips. Japanese yen used to make about 1,800 pips swing in a single day. So these things are nothing new. Probably once it is regulated and when there are filters provided. So you come across 150 pips swing, and in the case of euro, and 250 pips maximum in the case of GBP, etc. But when there is a liquidity crisis, you will come across invariably such moves happen, which compensates the weekly and the monthly permitted levels, and subsequently you will come across the market become normal. So don't be moved with that, and always try to look for the trading opportunities. And when you see when there is such a big drop in the market, and you have to understand, okay, when they stop cutting the new low, after forming around 3:30 GMT, they just held below that of the initial low. I'll just show the slide. The initial low in the case of GBP was 1.3466. I was telling you during that of the Asian session webinar time, that they are holding around that 1.34, and once it comes above and stay there for 30 minutes, they are expected to gain the levels. Or already at that time, Australian dollar, they made a brief downward stop and below that 73.10 up to that of 73.07 and came up and started gaining the levels. So, and also in the case of Canadian dollar, they started breaching they formed the high, started making the slide. So there is a very clear indication that they are just wanted to reverse the market after that of the extended downward stop limit. So they just dropped it along, and immediately, which has given the fear to the traders and also the institutions to liquidate the positions. But we are not questioning who has bought all those sell positions. People might be thinking those who have been taking sell positions, they would have just covered them with a profit and keeping the buy orders. But they went up to 1.5018 to start with. So they are not even spared the short sellers. They went up and hit all the stops there and started coming down. So either way, they made the whipsaw moves in the market and earned huge profit of their investments. And they made use of this voting to their advantage, and which has given that fear to the traders that the world has come to an end. Afterwards, no more world, and probably after the weekend, you will come across different stories creeping in the market, and everybody would have simply discounted British exit and then start trading. And that is what happens in the market every time. The market has capability of absorbing such shocking news. And also, market is known to forget such stories whenever the news story is creeping. So this is what happened after the extended downward move in the case of Euro and GBP. They started gaining above that of the initial low and stayed there for 30 minutes, and continuously they are gaining now the levels. So it will be a surprise for many people how come the market is making like this. Now, yesterday I gave the trade call, which I said that you can put it in the demo trading account and see. Actually, yesterday they came down drastically during that of the US session and came up to that of 1.13 level, and then they started gaining up to 1.14 to start with. And also in the case of GBP, they came down to 1.47, not exactly 1.4675, 47 they came down and went up to 1.5018 and started dropping. So if you use the trailing stop in a profit making position after removing the hedge order, you would have just profit. In the event, if, and also in the case of Aussie, it came up to 76.50, and in the case of yen, it came up to 106.84 subsequently, and then came down. So invariably, you find that we have to use the trading strategy to book profit with regard to the positions. And if we don't use the trading strategy, we will be caught vulnerably whenever they make such a big whipsaw moves in the market. Now, suppose I had taken a buy position in the case of Euro. Let me take one single example and explain to you the trading strategy. 1.1312, I had taken a buy. I failed to book profit. I kept order and left the place. It came up to 1.1427, then 1.1436 was not filled. Market started coming down. I did not keep the hedge order, or I did not keep the stop at entry here, and I kept only the hedge, and the hedge got filled. Then the market started coming down. So how to handle it? When the hedging is making profit for 30 minutes, understand the market is reversing. So there's no point in holding the buy position when the hedging is making profit. We have to identify whether it is an intentional move on the downside or an extended move just briefly. But the way in which it has fallen, we can understand it is an intentional move on the downside. Moreover, it was an extended downward stop. So immediately, one of the option is close the buy position and book profit in the sell position more than that of the loss made and that of the buy position. So that way you can take out the net profit when they are making the drop. The other alternative is, okay, let the buy be there and the sell is here. Then the market has come down. How long they can come? Can they come to zero? Can they make any currency a zero? That to a major? Not at all. They can just drop 100, 200 pips. They're all fourth decimal changes. So if you go in for actual currency conversion, there will be 1 or 2 cents variation when you are going for such currency conversions. So in the case of GBP also, you will come across only that about 2 to 3% reduction in that of the value when you are doing actual currency conversion. When you go in for that of the trading, then you find the fourth decimal changes that appears there is 1,600 pips drop and 1,000 pips drop, etc. And that figure invariably triggers the fear to that of the traders. So in the event when you have failed to book profit in the buy side, then the market has fallen. The one option is you can just close the buy and book profit on the sell, provided you identify that that downward move is an intentional move or an extended downward stop. Then other alternative is you wait for them to settle the new low by 3:30 GMT, and I noted down the new low around 1.0999, and then subsequently they dropped another almost close to 90 pips and recovered in 2 hours and started going above that of 1.1000 and stayed there. I could have simply booked a profit of 190 pips here, 180 pips, and then keep another 30 pips below a hedge order and trail the hedge order upward as they come. And once it started gaining the level, then I can close either the buy with a lesser loss. If I made about 100 pips profit or 150 pips profit in the sell side and close my buy with 100 pips loss, still I will have 50 pips profit. So that is how the trading strategy will help us to earn net profit from that other market. And also when you use the hedge order, what happens that in the case of yen, they dropped just like that from 104, 105 to 99.03. And actually there was no order. Simply it came and hit the level, and in fraction of a second it has become 101 again. Those who have watched the live market code page would have noticed it, that there are no trade or the orders in between. So in such a scenario, even if you place a buy position, buy order, you will not get it filled because that was triggered using a specific type of order just to hit the stops. Then subsequently, when they make such a drop, what you can do is you are making a buy. You think that USDN is very attractive around 101, you try to take a buy. But there is a fear it can go back to that of 99. But when you keep 30 pips below or 40 pips below the hedge order, you are only taking a risk for 40 pips. Okay, now people fail to do the bottom fishing. Why? Because they think that market could fall further down, market could fall further down. Why we are in a hurry to buy? But you buy and keep 30 pips below the hedge order. Let them fill the hedge order, doesn't matter. And see whether they are falling further down. And then keep the stop at entry in the hedge order if the hedge is making profit. And then later on, if they reverse and the hedge is closed with no profit, no loss, keep another hedge order trade with the risk. When they start gaining the levels, you trail the hedge order until you are able to keep stop at entry in the buy position, then continue with that of the buy position. That is one way of handling it. The other way of handling it, suppose you are just taken a buy and subsequently the market has dropped, you are hedged and it has fallen deep. Then you booked profit on the sell side, keep another hedge order. Besides, you take one more buy, and both the buys you close above the average, you make profit. So there are various methods by which we will be able to come out with the net profit. Okay, you are not able to think anything. The market has simply fallen, and you have got a huge, you have got a higher level buy and then sell, and you do not know what to do with that. It is very simple. You simply close the higher level sell buy with a higher level sell, accepting the loss of 40-50 pips. Simple. Simply close it with that of the hedge so that you don't incur any unlimited loss. After closing it, you re-enter into the market once the low is being set and not breached for more than 30 minutes. So that way you can enter into the market and you'll be able to recover the fund. So you might have incurred about 50 pips loss, but once you take a buy near that of the low, when the low has not been breached for 30 minutes to 2 hours, then you find that they come above that of the initial low and stay there. Comfortably take a buy, you will be able to win about 200 to 300 pips profit. So ultimately, what you need to do is aim for the swing trade. Use the trailing stop to limit the risk and profit-making positions so that you always come across that the market gives plenty of trading opportunities. Let me tell you, the world market has shown the stocks plunging like anything, about 3%, 4%, 5%, and 10%, etc. These are all just man-made situations. They just make the downward move in order to create the fear so that those who hold the delivery-based buys, they will also liquidate out of fear. They develop the fear that it could further make, it may make further drop so that it is better to exit. And that becomes an emotional decision. Later on, they find that at the lowest point, they have sold their positions. They repent for it. Most of the time, when the traders do trades out of fear, they repent later. It happened to be a wrong trade. So first of all, we have to develop the mindset that market means swings, and the players are going to make use of such opportunities. Either way, they are expected to make an upward move as well as a downward move. That's what they have done it. Even though the outcome is British exit in the poll, but still they went up to 1.5018. Why? They just triggered all the stops of the short sellers. Those who had taken the sell around that 1.494650 level, they simply hit their stops above and 1.50 and above, and then start making the drop, so that they were able to really dump huge positions. And once it started breaching 1.45, there may not be much orders. So automatically the players keep 100 pips, 200 pips below that, the bulk orders, so that the traders have got no other option than to sell 100 pips lower. If you wait for another 1 minute, 100 pips lower, you have to sell. If you wait for another 5 minutes, still 200 pips below, you have to sell. That sort of scenario they create. So you think that it is not better to wait for the market to recover. So if you sell early, you will be able to get a better price. That sort of scenario they create, as if the world has come to an end and money is everything. And these are all nothing but the positions. What you can do with the positions? If you take the position, they are to be closed in the market. You cannot simply take delivery or anything of that nature. The players, when they are sold heavily, they have to buy back the positions. They cannot simply exit the market and go away. Then the richest levels for them, the world number one, world number two, which will also deteriorate. They do not want it out of greed. So obviously you find that they will be in the market. From time to time they create such fear in the market using certain data release, etc. But ultimately you find they have to keep investing in the market and make their profits out of that. They make a very quick drop and the rise in order to discourage the traders or induce the traders. GBP is not able to go above 1.38. That is how they create that impression, so that the traders start selling. Those who missed all the bottom fishing, they think that okay, they can sell, anyhow the exit has come and automatically GBP has to fall, so they take the sell. And subsequently you come across the data release, or subsequently you come across the information, the market is oversold condition. So there will be a short covering. Then there won't be any seller in the market. And if you keep 100 pips above your buy, there is no seller. 100 pips above your buy, no seller. That is how the market goes up. Because the players know very well that once they accumulated all the buys at the lowest level, and if they don't sell, and the panic short sellers have to place a higher level buy, and the liquidity comes down, then automatically any level they feel like buying. Once they go in for the huge short selling, then automatically the short covering becomes a panic situation. That is why you come across severe upward move. And just yesterday, we have noticed during the European session how they jumped 100 pips just like that, mainly to induce the short sellers to do the short covering. So understand that players are here to manipulate the market, and they create such moves. Whether there is a voting or not, they continue to make such moves in the market. So one need to understand that how we are going to survive in such a situation. And you have to use the trading strategy, and only then you will be able to earn on either way moves of the market. And also you will be able to limit the risk once you use the hedging. And if you are not able to think anything once a position is hedged, simply you can close the original position with a hedge, accept the limited loss which you can really bear. And many traders fear that if they keep the stop might be hit. So they keep far away the stop, or sometimes they trade without a stop, thinking that okay, I have enough equity. But when they make such a big drop, the margin call would have been the phenomenon. So many of the traders would have got the margin call if they had traded without a stop today, or the hedge order. And the players do it, especially during the month end and the new month beginning time. So next week is the month end time. So the month of June gets over and the new month of July starts. So players are here to handle the derivative markets. So they are expected to make the lower level consolidation with a downward stop, and then start gaining again the levels, telling a different story. And the people simply forget about it. We know that Greece problem was there at that time. Euro was dropping like anything to 1.06, and it has recovered. So don't think that it is going to be a permanent setback for any currency. And all the sentiments created in the market are short-lived. If there are any question, you can ask me the question. I'm willing to answer to those questions. You can ask in the question and answer window. See how they have dropped 50 pips and gaining again in the case of GBP. So this is how they discourage traders taking buy position. But when they are making a dip of that nature, and if you watch carefully, you should be able to buy and quickly keep stop at entry and wait. That is how you should be an opportunity trader in the market. Today they are expected to make the rise all along during the European session. So, and also during the US session slowly for the weekend, and just watch how exactly they are doing it. Is there any other question? Any question? I can answer those questions. Okay. Okay, how should you handle the USDN now? See, USDN, they just made the drop, and you can take a buy position. Once they don't go below the 102.75, the psychological levels. 103 they are shown and come down below. 103 they show and come down below. See how they are handling the next psychological level, 102.75. And when they don't go below that, again for another 30 minutes, you can take a buy, keep 30 pips hedge order to limit the risk, because only in the case of GBP, they are making 50 pip swings, and all other currencies, they are making only about 23 pip swings in a given time. So you can just keep 30 pips hedge order to limit the risk, and once they start gaining the level, you quickly keep stop at entry in the buy position and remove the hedge order. If it is closed, then probably you will have a better lower level to buy. And always try to keep even tight hedge order of 10 to 15 pips also. And so that if they are not hedging you, you can keep stop at entry and remove the hedge order. That way you can limit the risk. At the same time, once the position start making profit, you will make a huge profit when they make a sudden upward jerking move in the market. And they are expected to make a quick upward move during that of the late US European session for the traders who had taken short position to come for a short coverage. Then afterwards, they will make a downward move as an early session swing during the US session. And then towards close, they are expected to make one quick rise, induce the short sellers to do the short covering, and also expect the higher level buyers to liquidate the long positions. So at that time, the dumping will also happen for the weekend because of the margin fear. Then the traders will dump the higher level after the gain. The traders holding the higher level buys will dump their positions. Then you will come across volatile move towards close around 19 GMT time, and then they will close in the middle level for the weekend. So that is how they are expected to accumulate the position, book profit with regard to the short sellers, and just to keep themselves clean with the profit. The players are very smart that way. So we have to be smarter than them, and only then we'll be able to earn money from that of the market. They have the money power, because of that they are very smart. But we have the intelligence, so we try to exploit their weakness and then try to earn when they are making big moves from that of the market. Any other question, please? Always keep in mind you have to follow the 25 pips psychological level or they are handling it. Every 25 pips, they will try to handle it, and invariably they will try to show the intermediary low or the intermediary high, which happens to be a prime number. That is how the market moves. Always keep in mind. Prime number is the one which is not divisible by any other number than by itself. Any other question, please? Okay, no more questions. So the spike trade call I gave yesterday, and we just shown profit, and again after that drop we could have just taken another buy. And as I explained, we have to follow the type of moves they are doing it in the market, and after that of the extended downward move below that of the initial low for 2 hours during that of the Japanese session, they showed very clearly from 5:30 GMT onwards started gaining the levels, and that indicate that they wanted to gain further levels in the market slowly and steadily. The quick moves are false moves in the market. So when they just made the quick drop of 1,500 pips in a very thin volume condition during that of the early Japanese session around 3:30 GMT, before 3:30 GMT, they made the drop based on their referendum percentage of votes, etc. Then when they made such drops, after the outcome of the results, you find the market has really become sensible, really calm, and making swings now. This is how they create the euphoria when the uncertainty is there. Once it becomes certain news, then they make the market to move slowly. And then we need to identify what they intend to do, whether they wanted to drop further or rise further. And then try to commit positions. We'll be able to really make money from the other market. The euphoric conditions are knee-jerk reactions mainly created in order to induce the traders to do distress trading, including the institutions. So they are expected to make the swing and rise during that of the European session and swing and form up during that of the US session. Okay, no more questions. So I take this opportunity to thank FX Street. Okay. I take this opportunity to thank FX Street for the opportunity given to me to give the webinar during that of the British exit time. And I want the traders to understand the importance of the trading strategy. And from time to time, the market is bound to create the fear. And they make quick drop and the quick rise moves in the market in order to induce the traders, that is the end of the line, and do distress trades. Subsequently, when all trades in distress, we fail to ask one simple question. When we are all willing to sell, who is buying? That happen to be the players. So they are smart in the market all the time. So try to become smarter than them. Wish you all happy trading. Wish you all happy weekend. See you on Monday. I'll come with a forecast for the next week.